Welcome. How's it going? How's it going? Love how often I'm seeing all the mastermind and pro names still in popping into here. Love people learning. Nope, this one's not part of mastermind. This is just classic OOT. But honestly, yes, I am gonna also be giving an options Greek lecture in mastermind as well, obviously. But this one is not it. $1K. Were you drinking all last night? Is that why you're telling me good morning?
No, I just thought I'd tell you that. I don't know why, but
So you're out drinking. You're out drinking all night and you're just waking up, weren't you?
dude, I'm old. I can't drink during the week. You're crazy, man. I
Mm.
need 3 days. I need 3 days to recover.
Yeah, I've heard all these excuses before. Is this a pre-class or a basics class? Well, I don't know what you mean by a pre-class. This is a pre-class class for me tonight. But uh, I, honestly, it's not the basics this tonight. This is not super basic stuff. This is more advanced stuff. It's something that I think people should use a lot more in their trading than they do oftentimes. Uh, but it's definitely a little bit more advanced, and we're going to be talking about some of it is what is happening in the market, not necessarily anything we can do about it, just something to be aware of. Just it's a bit of education, a bit of market knowledge that I think people should understand. And because we have an insane market right now, we have some really, really wonderful examples to just look at in our day-to-day trading and say, oh, so this is why it's that way. Our second, answering a couple DMs. Post out. Okay, just one more second. It's there. It's popped up. Okay, welcome everybody. How we doing, Dirty River? Happy to have you here. Uh, Tonight we're talking. I was kind of just saying this a little bit. I'm sure all you heard it, but tonight we're talking. We're going to start with a part of the market that most people ignore. I think as options traders, we really should take more advantage of it. It's something that I look at all day long. It's something that I just like to watch to see how things are moving. And so we're going to be talking about options Greeks tonight is going to be the main focus. And what the Greeks are is, if I had to break down option Greeks into one sentence, it's they tell you how much money you're going to make or lose before you take a trade. So that's what we use options Greeks for. We're going to go through all of them tonight. And then we're also going to be talking about VIX, VIX, VX, UVXY. There are all kinds of different, volatility instruments. So Ricky, nice to see you. So tonight we're gonna have yeah, Rob, you too. You're always ready to learn. So tonight we're gonna have, the initial part, we're going to be talking about options Greeks. I'll be showing you some examples of how you can use them, times where they're very difficult to use, like right now in the market. And then we're going to talk about what's been going on in the market, not anything about, economic stuff, no, not tariff talk, none of that. We know you know, the cloud over us is tariffs that is causing this, but we're going to be talking about option contract pricing right now, how that relates to Greeks, how that relates to VIX. And I'm getting constant questions about why are SPY contracts so expensive? Why am I in SPY puts and I catch a $5 dump and I make 30%, which is low. 30%, nice trade, don't get me wrong. But a $5 dump on SPY in a normal market, and you'd be up 2,000%, So that's what we're going to talk about tonight. Why does that happen? What are some things we can look at to have an idea of what the pricing is going to be? And then we're going to touch a little bit on, like proper decision making. And I'm hoping that throughout this class that we'll be able to, I've been trading much less. You guys know I trade SPY, I trade QQQ. I do halfway decent at it, trade it every single day. I've hardly even been trading them. It's not fun. If you're on the right side of, the move of a lifetime, of course it's great, but this market's just stressful. The pricing of these contracts sucks. You aren't making too much money. You're spending a ton to make a little. So I'm hoping by the end of this class, some people will, I'm not going to say don't be trading right now, but maybe get away, get away from SPYs, QQQs, your big names. Like you don't need to be trading $700 weekly Nvidias or Apples or whatever it is. There's better things to trade out there. And so, kind of a lot to talk about, but honestly, it's not going to take very long. The Greek stuff in the beginning is going to go relatively quickly. Of course, as always, please ask questions if you have any questions. If I'm going too fast, if you don't understand something I'm saying, then stop me and try to ask a question. And if I'm missing questions in the chat or anything like that, we got a couple people here, I'm sure that'll say, hey, River, you're missing questions in the chat, or maybe even answer your questions for you. But so with that, let's get started. Again, Dirty River, thank you. Thanks for being here. And let's talk some options Greeks and how can we use them. So what I'm pulling up right here, hopefully everybody's familiar with it. I'm sure we all should be. Hold on, let me make sure something. Have a hilarious way. Oh yeah, okay, we're good. Got a hilarious way of always accidentally sharing my account number when I'm doing these lectures, but I'm on my small port, so that makes me not care. So options Greeks, what are they? How can we use them? What are some ways we can use them to our advantage? How do I use them in my day-to-day trading? And what do they represent? So this is my option chain. These are the Greeks that I care about: delta, gamma, theta, vega. Implied volatility, not technically a Greek, but controlled by two things, and one of those things is implied volatility. Is a big part of vega. Vega tells you how much money you're making with those implied volatility moves. So we're going to get into implied volatility, VIX. That stuff is going to kind of be the second half of this. But first off, we're going to talk the basic Greeks right here, the ones that everybody talks about, delta and theta. These are the two that most people talk about. Theta is one that it's funny because here about a month ago, I was giving, I guess a month and a half ago, I was giving a lecture on options Greeks, and I was telling people, hey, you don't understand theta. Like if you're in a contract for like 30 minutes and you're saying theta's killing you, it's not, because theta is actually a rate of how much money your contract is losing. Delta tells you how much money you're going to make or lose based on the stock movement. So these are the two main ones we need to focus on. And we're going to start with delta first. And as I said, if I'm going too fast or you don't understand something, then try to stop me, please, because I know this is, I don't want to say advanced, but it is, takes a little bit of thinking. So we have delta. And what does delta tell us? Delta tells us how much money, so we have our, we have our delta right here. How much money will we make or lose if the stock moves $1. So what do I mean by that? If we buy calls at 518.50 and it goes to 519.50, that's $1 on the stock. So we receive one delta's worth of movement, $50 or whatever it is. It is accurate, but you can be off by a little bit due to the Greeks always moving. But how do I use delta day in and day out? I use it for risk reward calculations. Say, and we're making up trades. Don't go try to trade off these like random numbers that I'm saying right now tomorrow. Say that I am entering some calls 518.50, like we said. Well, maybe I think the official breakdown comes down here about 517. Well, now I'm planning this ahead of time before I'm in this trade. You need to think of these things before you're in the trade. Well, now that we know where our entry is and we know we're risking $1.50, we can now go to these contracts and say, okay, how many delta do I have? I have $50 worth of delta. I make $50 for every $1 it goes up. I lose $50 for every $1 it goes down. So we know we're risking $1.50 of downside movement before we think the breakdown is coming. That means that our contract is going to lose 1.5 delta values, which is $75. So now we have identified our risk on this trade. We're trying to get in here at 518.50. Well, maybe we're looking for this, this move up here to this 521.50. Nice kind of these previous highs on these candles. Maybe we're looking for that big of a move. We know that's a $3 move up. Obviously, we have to acknowledge today's market. These are very likely too wide of price targets in a normal market. Not too big of a deal right now. But then we go back to our delta and we get to look at our delta and say, okay, I'm looking for a $3 move up. That means I can potentially make $150 on this trade if I get my $3 move up. And I'm risking $75 to do this because we know $1.50 move down, and I'm risking $75. So this is how I analyze risk reward. Obviously, when I'm trading or anybody's trading with me in voice chat or even just been to my lectures, that I always do this step first, and I always use the equity to figure out, the stock, SPY, whatever it is, to figure out what my risk is. So I will always, when I'm discussing risk reward, I'm always going to discuss it based on the chart. I'm never doing it based on the delta of options because it can move so much and they can be so volatile. So all I say is $1.50 risk, $3 reward. I got one risk, two reward. I do that in my head real quick and I say, okay, that's a good enough trade for me. And so that's how I use delta. It's the one that I think people should realistically be looking at every single day before every single trade that you take. It's that, one of the prime examples of people who don't understand it. Obviously, in this market, it's a little different because you can trade so far out of the money and have it still work. Some will be like, I'm in Tesla calls and it's gone up $5 and I've hardly made money. That's because they probably have like $2 or $3 delta because they're so far out of the money on their calls that they're only making a couple bucks for every dollar Tesla moves. So their contracts aren't really moving. That is why, and I know it's difficult right now, and not even I am doing it, but I almost always recommend trading as close to the money as you can. On some of those volatile names like Tesla or even SPY, you can of course be $1 out of the money, but don't be the person that's in $25 out of the money weeklies on Tesla, wondering why your contracts aren't paying you when the stock's going in your direction. Keep your strikes reasonable. And how do I identify if a strike is reasonable? By the delta. I oftentimes, this market sucks for it, but we'll try to say, okay, if I'm paying $700, how much am I paying per delta? And is that trade really worth it? Because I buy this $700 contract, I catch a $3 move on SPY and I make, what is that? 15% on a $3 move on SPY. The risk reward just isn't there on SPY right now. If this thing starts going against you, you can really lose some value quickly. But delta will always give you the ballpark of how much am I risking to potentially make. So it's pretty simple, nice and easy to understand. Everybody get delta? Yes, we're going to take that as a yes. Thank you, Ant. Silence speaks volumes. Okay, so up next one that we're going to talk about is theta. Thank you, everybody. Appreciate it. So next one that we're going to talk about is theta. People talk about theta all the time. Oh, I'm getting theta burned, blah, blah, blah. How are we risking $75? Yeah, thank you. Please ask these questions. So as you can see, these numbers are still moving. So I'm saying $50. And we know that delta is based on movement of the stock. That is all that matters. The price of the stock moves the option contract's price. The option contract price does not move the price of the stock. That's why when you hear people try to say, oh, somebody's buying all these Tesla calls and pumping it, they don't know what they're talking about because that's the opposite of how it works. Uh people use, people try to like think they know what the market is able to do and think they know how the market works. And very oftentimes they just have it wrong. We need the stock to move. If the stock starts moving, people start buying calls or puts or whatever. Sorry, that was funny. Yes, though. People start buying calls or puts because the stock is moving. People don't start buying calls or puts based on what the options are doing it. Yeah, see, that one made me laugh. They're doing it because of what the stock is doing. So how do we get to $75? And again, Robs, we're using random numbers on the chart. We're pretending we entered here and we're pretending our breakdown is down here below 517. So we are risking $1.50 move down. So when we have about 50 delta and we know delta is for every $1, we're risking $1.50. So we have 1.5 deltas of risk, which is about 75 bucks. If we're calling these $50, it's about 75 bucks. And then the exact same way, we're making up again. Don't go take this trade tomorrow or anything based. I mean, maybe do based on this level. I've been trading off it, but if we buy calls here, we're looking for the $3 pop up here to the previous resistance. Now we can go to our delta again and say, okay, we have 3 deltas of upside to make 150 bucks. Yeah, question on delta. What is it? Send it. Unless that answered your question. Okay, so on to theta. Theta is the one that everybody talks about. How does IV affect delta? Good question. Does not affect delta. There's only one thing that actually affects delta, and that is gamma. And we're going to talk about that in just a second. But it's really quick. But IV does not affect delta. IV affects other things, and we're going to get into what it does soon. And so next one we're talking is theta. People love to talk about theta. Oh, I'm getting theta burned or whatever it is, blah, 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 things like that. Oftentimes they really don't understand what theta is. And theta is actually a rate of change. So it tells you, based on a 24-hour period, how much value will your contract lose? So in a normal time where the contracts are much cheaper, theta is only maybe eating a couple few bucks of your contract per hour, because you have to think when you look at theta, and for example, right now, it's $797. And what that is telling us is by tomorrow at close, if these are not in the money, they will be worth $0. That's what it's saying, because theta is what is known as time decay. So as time goes on, the value of your contract decays. Well, in a normal market where, theta's down there around $100 or whatever it is. So it is very good question here. It's not like noon hits and you lose 1/24th of theta. It is over a 60-minute period, you are losing 1/24th of your theta. So in a normal market, it's not a ton. However, when we have, $800 contracts, off the top of my head, 30 bucks, 35 bucks an hour is what you're losing on the value of this contract. So we are actually in a time where if you hold a contract for an hour and you lose $30, on a $700, $800 contract, you're losing what? 5% of your total contract value. So we are at a point where, timing is important because theta is actually having a bigger effect on us. And so it's something we need to be aware of because, contracts go to zero unless they're in the money. And so that is what theta is trying to tell us, is that these contracts are going to be tomorrow. And so they're getting beat up very, very quickly. Well, if we start looking at month out expirations, we can see that our contracts that expire tomorrow will be worth zero at close tomorrow. If we closed at this exact price tomorrow, then we would be at zero tomorrow. Well, if we go out a month, random day, all of a sudden we can see these contracts still appallingly inflated value, $2,400. You're only losing $36 a day. The closer you get to expiration, the higher the theta is going to be. So that's why when people, those of us that try to get people to trade safer, we always try to tell people to buy time. People like, 1K is a great example of it. He trades some of those slower movers where it's pretty dang affordable to maybe buy the next week contracts. And why do you do that? So you are not fighting theta at all. And so that's, that's one of the that's what more people should understand about theta. When you're got 100% theta, your contract's going to zero at the end of the day, you're in a fight with the Grim Reaper. When you have a month's time, you can relax. You can swing it if you need to swing it and know that, market movement might dramatically affect your contract value, but theta is not going to be doing a whole lot, $36 off of 2,400. And so, that's very, very, that is why buying time equals safety. Of course, if you're, this isn't what this lecture is about, but, if you're buying time, that doesn't mean that you don't stop out when you're wrong. You're just buying that time for a little bit of added safety. But what's the other side of that added safety? What adds that? Dramatically increased cost. So that's theta. Everybody get theta? Oh, Ricky, great question. Theta does not apply when it's in the money. 100% wrong. People love to say that. It is 100% wrong. So I'll explain it without getting into too much detail. Because again, it's not what this lecture is on. So option contract, what an option contract is you are actually entering a contract with somebody else where you have the right, but not the obligation to buy 100 shares at whatever your strike price is. So what that means is, theta is confusing, Kath. Well, ask some questions. Let's try to make it unconfusing. It shouldn't be confusing, but try to ask some questions. Let's get there. But so a lot of people try to say theta doesn't apply once in the money. Well, when your contract goes in the money, it has what is known as intrinsic value, because, if I'm in 520 calls and we're trading at 522, I'm $2 in the money. So I technically have the right to buy that 100 shares of SPY for $2 below market value. Well, that's great, that's awesome, whatever. That doesn't mean you keep all of the value of the contract. What that means is you have $200 of real value because you can buy 100 shares at $2 below the asking price. So you have the opportunity to make $200 right there. That's what intrinsic value is. Well, here's the issue with that. And today's might be, oh, and we're moving a bunch in the after hours. So here's the best way to think about it. For every 1 cent that you are in the money, that is $1. So do you get what I'm saying there? So you technically have 100, like your option contract represents 100 shares. So for every 1 penny, you have $1 of intrinsic value. So if you're $10 if you're 10 cents in the money, you have $10 of intrinsic value. If you bought that option contract for $100 an hour before close and you're in the money, it is only going to be worth $10 at expiration. You might notice on some of these same days, obviously market is moving and we're probably on a $1.50 lower than we closed. You might notice we still have some value here. We're going to get into that in just a second here, but in the money does not mean There is no theta. In fact, theta is exemplified, especially if you are looking at anything above intrinsic value. So, if you're $1 in the money and you bought a $300 SPY put into close or whatever, or SPY call into close, and you only end up $1 in the money, your $300 contract is worth $200 thanks to theta, or is worth $100. You lose $200 thanks to theta. So yes, theta absolutely affects in the money stocks. You can, or in the money options, you can even look at it right here. Here's a great example. $318 worth of theta. These contracts, they will be at, those would technically be at zero. $300 worth of theta, $30 or $30 to $70 worth of value left on them because you're 30 to 70 cents in the money. So you're going to lose this $300. No matter what. So yes, theta has a very dramatic effect on in the money contracts. It's actually almost always the highest values at the closest in the money strikes will have the highest effect of theta. Does open interest affect the Greeks? No. I'm saying that there's times and places, yes, but no, more than anything, open interest affects your bid-ask spread on the price of the contracts. Yep, Crashmas, exactly right. I preach it all the time. We're a bunch of nobodies trading against people with like PhDs and things in economics in the most advanced financial market with the most advanced financial instruments in the world. It's not going to come overnight. How do after hours moves happen? Because the market doesn't actually, the major markets close, but they don't close for, they close for maybe 6 hours overnight. But then those overnight datas that we're seeing on things like Thinkorswim, Robinhood, all of them, they're drawing data from international markets, like there's Apple shares for sale on China markets and German markets and all of the markets around the world. So they're drawing the data from those different markets for when the markets actually, that's the 24-hour data we get. But all of the stuff that happens from the 4 o'clock to 9 o'clock, sorry, I never know, I'm on the West Coast, until the market actually closes at night on the East Coast for that like 6-hour period, that's the only time that the New York exchanges aren't still doing things. Can you buy and sell options after hours? No. Psyduck, so your question here, one spot out the money, you will lose if you buy time, your percentage gain and loss will be smaller. Your percentage gain and loss will be higher on shorter expiration. You buy a $300 contract and lose $40 worth of delta, that's 10%. You buy the $90 same day that also has 40 delta and it goes against you, that's 50% of your contract. Yeah, so I don't know if that was your question. SPY and QQQ, GLD, there's a few things that you can trade for 15 minutes after close, but and yes, you can buy and sell them. It's very low liquidity at that time, but yeah, you can trade those for 15 minutes after close, but nothing more than that. You get a few candles after the close and that's it. Okay, so are we good on theta? Are we good on delta? We got those down. Next one is super easy. Okay, perfect. That's all I need to see. Gamma is the next one that we're talking about. This one is a piece of cake to understand. So remember how delta, it moves up or down based on $1 on the stock. Gamma does a similar thing. For every $1 the stock goes up or down, gamma is what adjusts our delta. So if we have 46 delta, SPY goes up $1, we will now have 51 delta. This is where the real power of options comes from. It's why I always, nope, same days. You can do same days, as long as you aren't on Robinhood or Webull, but all the other ones, Tastyworks, Interactive Brokers, Thinkorswim, all the real reputable ones are great. So Gamma, again, SPY moves up $1, we add $5 to our delta. That is where the real power in options comes from. It's why I tell people to not trade out of the money. The move from out of the money to in the money is the most profitable move you can make in options, and it's why options are such a powerful instrument. You get, technically speaking, additional leverage at no cost to you. So a very easy way to think about delta is, I was explaining each option contract represents 100 shares. Well, when you have 46 delta, that basically represents 46 shares. You're getting the same return on your contract as if you owned 46 shares. Well, if we get that dollar move, now you have the exposure of 52 shares at no additional cost to you. So while your first dollar move paid you 48 bucks, if you catch another dollar move, that one pays you 54 bucks. You catch another one, it's going to pay you 59 bucks. So you gain additional leverage at no cost to you. That is why you might have heard me talk about, gamma shift, things like that. That is where when you are at the money, you will always have the highest gamma. And when you go from out of the money to in the money, your contract will start gaining more value quicker, and it will be more dollars for smaller moves. That's, even more reason to not be trading those wildly out of the money things, because you get such great exposure to the market in a leveraged manner when you wind up in the money. So gamma adjusts delta based on stock movement. Everybody get that? It's not one that you really need to. So I should say this. Don't care about gamma. Don't ever try to base a trade. You might hear people talking about trading gamma levels, GEX levels, things like that. Different idea. Still talking about this gamma, but a different idea. So don't worry about gamma for your trades, but know that when you're in a trade and it's going in your direction and you're super happy, give gamma a nod and tell it thank you for helping you make more money on less movement. That's don't ever adjust your trades based on it, is the best way that I can put it. So does everybody get it? Got it. Rob's got it. Like I said, simple one, doesn't take a bunch of, doesn't take much thinking or anything like that. So next one that we're going to talk about, more advanced, takes a bit more thinking, is something that can dramatically affect your contracts, and something that we're seeing big effects from right now. So this next Greek that I have on here is Vega. And what is Vega? Again, since all these Greeks work together, one is almost always going to work with another. Vega, interestingly enough, works with something that is not technically a Greek, but a Greek is about 50% of its existence. And so we got Vega, and Vega tells us how much value will our contract gain or lose. That's what all these Greeks do. They tell us ups and downs. How much contract or money will we go up or down if we lose 1% in IV, in implied volatility? So we can look right here on SPY. And this one, there's going to be some talking involving this, and it's going to lead into our last talking point of the night. So we can look at SPY right now. We can see that these contracts are ridiculously expensive. The reason they are priced expensive is IV. And so, when do a lot of people talk about IV? During earnings. When you get killed on an earnings trade, that's IV's fault. Without a doubt. So what does this tell us? For every 1% of IV we lose, the contract is going to lose $10 right now. That's massive. As you can see, we're in the after hours, so these still move around. If you get to the same days, they start to get volatile. They start to get very high IV. In a normal market, we'll see 20% IV. It's pretty common on SPY, QQQ. We'll see 20% IV. You won't ever see zero IV. It adds a little bit of value to the contract. So when we look at this and we say to ourselves, how is a 1 day to expiration contract $865 to go at the money? Because of IV. It's all thanks to IV. We know that SPY, a tomorrow expiration, one DTE at the money, 150, $200, pretty dang common. We know that right here, we have 85% IV on these. So if we subtract that 65% IV that normally isn't there, then all of a sudden this contract loses $650 in value. And all of a sudden we're down to, oh, nice. I got lucky on when I was saying random numbers. All of a sudden we're down to $200 for a 1 day to expiration SPY contract. Pretty dang common. That's a pretty dang reasonable price on an at the money contract. And so this IV Vega relation is why these contracts are so expensive right now. Why you catch a $2 move and make 20% on a $3 move and make 20% on it. And what is I see it. What does 50% IV mean? So that's what I was just going to get into. What does this mean? How I like to look at it, think about it, nice simple way, right over here on the right hand side of the option chain. So we see it's telling us 72% IV right here. So what does that actually mean? And that's, we were seeing, I mean, some are a little bit higher. It's rounding, it's rounding. So, what does this mean? Well, see this number next to it. Um, See this number next to it, plus minus 14. If you've ever heard people say the market is pricing in this big of a move, well, that's what this number is. The market is pricing in a $14.6 move right now, which is a very, very, by throughout tomorrow. That's a very, very large move. And it adds 60 to 70% IV because of that. So that's what we're seeing here. We're seeing contract values that are inflated by $10. These things are trading what a $6, $7, $8 in the money contract should be trading for, trading at the money. And so why do market makers do this? Because they're smart. They know that they have to protect themselves and they know they have to sell things at market value. So when something like $14 is being priced in, that's what they're selling us. They're saying, hey, if you want to trade this, we're already predicting this much movement. If you want to be in there, have at it, but it's going to cost you this much money. And so IV and Vega are something you need to focus on. So now we can get to the other side of it. How does it move intraday and how does it affect us? Well, when we get a gigantic move upside, IV is increasing the whole time and then it starts dying off. When we get a gigantic move downside, IV is increasing and then it starts dying off. That's why you might hear me or Flips or anybody else say, if you get a big old pump candle, sell on that. Because if we bounce a little bit back to that level, there's a very good chance that the IV's pulled back a little bit and it won't be worth the same value that it was. So that's what we have seen with some calls lately. We catch a nice bounce, $5, $6 bounce, make 30 or 40% on it. That'd be thousands of percent, 2,000% on a normal life contract. Why is that happening? Because we're probably losing 10% IV on the way up. So, we might think our contract should be up $300. It's up $200 because we've actually lost $100 to IV on the way up. That's why things aren't paying that well. And, don't get me wrong, some things are paying really well. Don't get me wrong. You are in calls right here and you catch this move. You made a ton of money. Super happy for you too if that happened. You made a ton of money. I'm more talking about, we're having nice movement, $20 intraday movement. People are holding puts for this whole, $10 move down that's more of a grind down, doing 200% on a $10, $15 move because they're fighting IV all over the place. And so that is why contracts are so expensive right now. And when are they going to get cheaper? All of that, who knows? But it's become very important, in my opinion, and something that I've really had my eyes on, and I always have my eyes on, to watch these IVs. If I'm in a trade and I'm seeing IV go up, because when it goes up, it can also add $10 to your contract as it's going up per percent, So when I see it go up, and I'm in a trade and it's going that direction, I'm taking a trim. I'm using IV to really help me say, okay, I need to sell into this pump or whatever, because my IV popped 3-4%. So I got an extra 20, 30, 40 bucks, whatever it is. Or if it's really going against me and I'm seeing that IV start dropping a little bit, I'm very likely going to start considering a stop out maybe sooner than I would, because I know that without an IV pop, I need a big move just to get back to where I started. So the IV Vega correlation has been absolutely gigantic lately. Does everybody get that one? I know it's a little bit more advanced, but hopefully everybody gets it. Got it? Okay, and then so generally speaking, somebody always asks me, well, how is IV calculated? And I do the same thing every single time for it, because that kind of sort of rubs. If you don't get it, we're going to keep going over it. But I do the same thing every time just to show people. So if you want to know how IV is actually calculated, uh-oh. Taking notes that you're going to put in Chat GPT. I like that. So here we go. If you've ever been curious, this math right here is how IV is actually calculated. So it's extremely advanced thing that we're really, dumbing down right now. And so good question. Yeah, so yeah, we're gonna get into that one next. Yep, VIX relation. We're coming to that soon. Coming to that. That's part of next. So, and then I see a quick one answer. Rule of thumb: we want low IV. For cheaper contracts, we want low IV. Cheaper contracts give us much better chance of making good money and large percentages with lower IV. There's times and places where if you're on the right side of it, high IV and IV really kicking in for you is an amazing thing, and you can take advantage of it. But a nice rule of thumb is lower IV and you can care about it a lot less. High IV and it needs to be considered. Okay, so Rob's again, IV. We have our percentage right here, 87. This drops to 86, I lose $10. Like, to really make it cut and dry, it's not going to be 100% perfect. I'm going to tell you that right now, especially with how volatile it is, how quick everything's getting priced right now. But we go from 87 to 86, we're losing $10. It's that, like, it is that cut and dry. It will never be that exact, just due to how quickly it can be moving. And so, um, and so this is just, keep it simple. Don't get too hung up on it, but understand if you see, oh yeah, so Vega strictly tells you how much you're making or losing based on the percentage. That's, strictly do it that, like, that is all it's telling you. Same as Delta, how much are you going to make or lose based on a $1 move? Vega is telling us how much are you going to make or lose on a 1% move on IB. Keep it nice and simple. Why are options high expensive? What's the relation with the VIX? That's here coming here in just a second. How can you use the Z-score to help you with the market? I'm going to just 100% tell you need to get with Assassin on that. That's the guy to talk to. I'm not going to pretend like I can explain that anywhere near as good as he can. Z-score is his thing. I think it's a real powerful tool if you figure out how to use it. Okay, so with that, that's Greeks. Everybody got the Greeks? Any questions? Anything else? Well, options are expensive with high IB because it works this way. It's 60% higher than it is. So we know $10 per percent, we know they're $600 more than they're expensive. But we're going to talk about one of the things that yes. Oh, well, yeah. Okay. So if this goes against you, you're exactly right, Rudy. This contract, let's say this contract costs us $850. It goes $1 against us and IV drops 1%. We're losing $60 because we're losing $50 to Delta and we're losing $10 to Vega and IV. But again, do you really need to sit there and do the math? No. When you're doing your risk reward math, more focus on Delta. But so now we are going into while it doesn't affect IV, technically speaking, the price of it doesn't affect anything else. VIX. I think it is one of the most wildly understood things in the market. People talk about it all the time. People try to do technical analysis on it. You can see down here. This is what I tell people all the time. You care about the whole numbers. You do not trade them as support and resistance. You don't draw trend lines on this. You don't use indicators. You might notice down here, no volume bars because there is no volume. VIX is only tradable, VIX specifically. There's other equities that you can trade it. VIX is only tradable through derivatives, which are options contracts. So don't ever do TA on VIX. If somebody tries to do TA on VIX, laugh at them. Tag me in the post so I can teach them something. Do not do TA on VIX. VIX tells us, and it's funny because I have a cheat sheet for it. Um, uh, Give me 1 second. I forgot to pull it up before, but I have a cheat sheet for it that tells us what VIX actually means. Here you go. What VIX tells us is a few different percentages: 68% chance, 95% chance, 99% chance. If VIX is trading at any of these prices over here, it's funny because we're outside of these prices, then we know if VIX is at 30, there's a 68% chance, also known as a pretty dang good chance in the world of trading, that we will be in a 16% range in the market over the next 30 days. A 95% chance we'll be in a 17% range, 34 total percents. Of course, that's 95%. So that's what VIX is telling us. VIX is at 40. We can pull up our cheat sheet. We can extrapolate it a little bit and say that the S&P will very, very likely be in a $14 or 14% up or down range over the next 30 days. That is what VIX is telling us. So when VIX is high, market makers, they can use their calculation to figure out IV, and they can use their bias to say, okay, VIX is trading at 30. That means there is a very, very high probability that there's going to be extreme volatility in the markets. VIX is at 40, VIX is at 50. They know there is going to be high volatility. So while they do not affect each other, technically speaking, you can make the correlation of VIX high, IV high. That is a perfectly fine correlation to make. VIX going up and ripping midday does not necessarily mean IV is going to be doing it, because they use what I showed you guys, the Black-Scholes model, to actually figure out the math on IV. And these computers are doing it, millions of times a day to keep those IV percentages moving. What VIX is telling us is how much volatility can we expect over the next month. And as we can see from here, it's been pretty dang right. We had it here a month ago or whatever it was, about a month ago, telling us, hey, you guys should probably be prepared for a 10% up and down range over the next 30 days. Well, here we are 30 days later with the S&P down 15% off highs, and it was obviously already coming down off of highs a month ago. And now we're down 15% off highs. So VIX is accurate. The people who are running VIX and doing the math on VIX, it's accurate. So always be taking note of it. When we see these huge blowouts on VIX, sometimes they mark a bottom. Other times they show us extreme uncertainty and we get to know volatility is here to stay. So I keep getting asked, when are contracts going to get cheaper? I can't give you that answer. Nobody has that answer, but contracts will be cheaper when we get VIX back down to 20. That's when contracts will be cheaper. So again, the VIX chart, is it something you need to pore over? Is it something you need to watch, all the time and think about it all the time? No. I mean, you can use it in your trading. Don't even look at the numbers over here. You see movement like this on VIX, and you can very likely assume that the market is going to be going down when it's this high. A lot of people try to say VIX up, market down, VIX down, market up. It's kind of true, but statistically, it actually moves in the same direction as the market about 30% of the time. So we know if VIX is exploding like this, the market will likely go down. If VIX is dumping like this, the market likely will go up. Again, you do not do technical analysis. You don't do any of that stuff on something like it. But you can always look at these kinds of things and say, okay, you know, VIX is exploding, market is dying, VIX starts dumping, and market starts bouncing. It's like we can see that correlation. We don't need lines on these charts. We can just glance at it and say, what is VIX doing? VIX above 20 brings some volatility, it generally does. Contracts will still even be a little bit pricier over 20. We all got so spoiled for the last couple of years where we had great data, great answers, great planned out method where, same days were costing us 50, $60 or whatever, because VIX was spending a lot of time down here in this, for a long time. VIX was looking pretty dang good down here below 20. So we had multiple years of cheap contracts that were cheap contracts, pay you more and have less dollar risk. So for us, it's an amazing thing when VIX is low. Is it better to trade options in lower VIX? I won't say it's better, but I will say it's better. Yeah, it is better. You make more with less risk. I mean, to me, that's better. But some people, they get sucked into the fact that the market's moving $20 a day, and they ignore the fact how little they're actually making on those moves. So as VIX goes up, not necessarily, but it can. That's the thing with all of these. Nothing is cut and dry. I've seen VIX going up and IV on contracts dropping plenty of times. I've seen VIX going up and IV going up, VIX going down and IV coming down. I've seen it do both plenty. Very volatile moves, upside moves or downside moves on VIX often will be met with an IV increase or decrease depending on direction, but still not a guarantee. Crash miss. Great question. Honestly, about like I said, I like 20% IV, 20 to 30% IV. I like that. You can get a nice volatile move is going to pay you good. Moves against you aren't going to get you clobbered by the Vega loss. 20 to 30% is good. SPY and QQQ. If you're trading Tesla, its IV is going to sit a little bit higher naturally. It's a volatile name. If you're trading Nvidia, that IV is going to sit a little bit higher because it's a volatile name. So I can't really just give, only buy contracts with 25% IV because it's kind of different contract by contract, or stock by stock, but SPY QQQ 20 to 30%, your volatile names, your Teslas, your Nvidias, I like, I'm okay with 50% on those. Sometimes it's even more, but I don't have a like on Delta, I can tell you I'll almost never buy a contract with less than 35 Delta. That's kind of my line in the sand of where I think the risk, the value is worth it. The price per Delta is worth it. I'm never going to buy one. I can't give you something that direct on IV because it does just vary, so much trade to trade. Yeah, Rob, I mean, I would normally tell you to trade T, but I was looking at the T contracts are sitting at 50% IV. They're normally like 10 or 15. And so, that was even, I was laughing, like $1 out of the money T contract is $50 or $40. So for SPY and QQQ, for me, 20 to 30%. I like that IV. If we're at 20 to 30%, we know we're seeing a little bit of volatility in the market as a whole. So there's enough, there's enough juice in the market for me to want to trade it. But like I said, the IV amount is rarely going to affect my choice to take or not take a trade. It will affect some of my choices in the trade potentially. If something starts happening that IV really starts going against me or anything like that, I might use it to say, okay, this is going to be hard. Like chasers deal with it all the time. You buy the top of the big green candle looking for more, and you get a little pullback, and then where you bought it, you're already red at the same entry price a minute later. That's really, that's where IV really starts getting people. Chasers are the one who gets killed by it. Oh, did I change it? Massively. I mean, I have sized way down. I'm trading way out of the money compared to what I normally do, which I hate doing. There's even been a bunch of trades that I haven't um uh I haven't even really I've taken one or two spy trades a day. I've been trading these. I even got a few of them riding in my small port. Your SQQQs, your TQQQs, I mean, they aren't, some glorious trade, but and trading it as shares, here's a 12% move intraday on shares. These have been great to scalp. I mean, obviously I size up a little bit because they're shares. So, it's got to be worth it. You still respect your stop loss, but it has been wildly common to take, if we're going down, SQQQ is the one I like. If we're going up, TQQQ. So it's leverage, Spire or leverage QQQs. So just as an example, that move on QQQ yesterday, truly mind blowing. I mean, wick to highs was 11%. Amazing move. Tricky to make money on. I was trying to get in there, and those spreads made it virtually impossible. I still question anybody that was telling me they were getting good fills there. Well, TQQQ, low to high, you got a 33.6% move. So very, very nice move right there. So I've kind of been trading these, scalping these. And I mean, I know they're shares, and so they aren't going to give you your 1,000% return, but they're sure going to give you a whole lot more safety and still give you a pretty dang nice return. But so yeah, sizing down, and then I've been trading a lot of the other names. Your AT&Ts, your Coca-Colas. I mean, those cheap names are like, dude, we hit a nice one on T this morning. We bought this pullback on T this morning in the I don't remember if we were in pro or mastermind this morning. Bought this pullback. This 50-cent pop paid us, and no, I think I was even out here. 50-cent pop paid us about 50%, and then they ended up going 100% just on this move. So I mean, those cheaper names have been money. What has best read CBS? Yeah, a lot of the cheap names do. Honestly, right now in this market, Rudy, never. It's always high IB. But generally speaking, your IB will be slightly lower through kind of that lunchtime hour. I think that the people that say don't trade at lunchtime and never makes moves are wrong. I hit many of my best trades of the day come at lunchtime. I love the lunchtime trades. But right now, IB is going to be high no matter what. And then when IB is lower and we're in a normal market, we don't really care about it. When IB is down there at 20, 30%, it doesn't affect our trading at all. So there's no point to really think about a specific time of day when it's low. As long as IB is low, we're happy. Okay. Well, I hate to do this. I normally love to ask questions, but I unfortunately got to call it right now. I got to start another lecture here in about 1 minute. So thank you everybody so much for being here. We had an awesome turnout today. I'm shocked to see that 60 of you guys showed up. That was amazing. Thank you so much. And if you have any questions, I know some of this was advanced. All of you know, my DMs are always open. Any questions about the lecture or anything else, no big deal. Send me a message. Let's try to get you on the right page. Obviously, if you're sending them tonight, I might not get to them tonight. But my DMs are always open. I'm here to try to teach everybody. Sure, I give alerts, but I'm here to teach you guys how to trade and do it yourselves. That's my main goal always. So ask questions. Any questions you got, feel free to send them my way, and we will try to get you on the right path. And with that, thank you so much, everyone. We'll catch you all tomorrow, Friday. I know I'll be trading in OOT, so let's have some fun. Yeah, Zeke. Hey, we all got a ways to go. I mean, man, I've been at this 14 years, learning every day. That's how it goes. So thank you, everybody. We will talk to you all soon.